Ladies and gentlemen, good day, and welcome to Satin Creditcare Network Limited Q4 12 months FY26 earnings conference call hosted by Dolat Capital Markets Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Puneet Palani from Dolat Capital Markets Private Limited. Thank you, and over to you, sir.
Yeah, thank you. On behalf of Dolat Capital, I welcome all the participants on this call and thank the management of Satin Creditcare Network for the opportunity to host this call. For today's call, I have with me the members of the management and leadership team. This includes Dr. H.P. Singh, Chairman and Managing Director, Mr. Jugal Kataria, the Group Controller, and Ms. Aditi Singh, the Chief Strategy Officer. And with this, I now hand over the conference to Dr. H.P. Singh, Chairman and Managing Director, to provide the opening remarks of the call. Thank you, and over to you, sir.
Thank you. Thank you, and good morning, everyone. It is always a pleasure to speak with our investors, analysts, and partners who take time to engage with us on our journey. FY26 has been a year we can look back on with immense satisfaction. It has been a year that tested the sector and in doing so, highlighted out the differentiated institutions that are structurally sound. I am proud to say that Satin belongs firmly in this category. The numbers speak well, but what I find more meaningful is what they represent. The outcome of a long-term commitment to quality, discipline, and responsible growth built over 35 years and now clearly visible in our performance. Let me begin with where the sector stands because our performance will further benefit from industry green shoots. FY25 was by any measure a difficult year for microfinance. The sector navigated a confluence of headwinds, borrower over-leveraging, state-level disruption, and a tightening of credit standards across lenders. The industry's gross loan portfolio contracted, credit costs spiked, several institutions saw significant deterioration in asset quality. The stress was real, but so was the response. SRO guardrails, the 3-lender cap, and the 2 lakh borrower exposure ceiling have meaningfully reshaped the lending landscape. These are not just regulatory requirements, they are the building blocks of a more responsible, sustainable credit ecosystem for underserved India. By early 2026, the sector had passed its stress peak. Portfolio at risk for loans overdue between 1 and 180 days stood at 4.7% as of January 2026, down from its peak 6 to 7 months earlier. Disbursements recovered sharply. According to CRIF Highmark's Microlend report, microfinance originations grew 25.8% quarter-on-quarter to 77,555 crore in Q3 FY26. Average ticket sizes rose 18% year-on-year. The sector is healing. Also, the credit guarantee scheme came with a timely and much-needed shot in the arm to help the sector accelerate towards a sustainable growth. What is equally important is how the sector is healing with tighter underwriting, reduced over-leveraging, and a stronger focus on borrower outcomes. This is the kind of recovery, and it is one that Satin is not just participating in, but leading. This year, we completed 35 years. I do not say this to mark a calendar milestone. I say it because longevity in this sector means something specific. It means you have been tested repeatedly and you have come back stronger each time. This becomes more relevant for an institution like ours, where I have a significant skin in the game and steering the institution with experience and outshining on every parameter. We navigated demonetization, we navigated COVID, we navigated the current MFI stress cycle. Each time we did not simply survive, we took the opportunity to improve. A SAM, which once represented a risk and a point of concern, today has a PAR 90 of just 0.7% and collection efficiency of 100%. That is what a 35-year institution does with adversity. It converts it into capability and opportunity. Our management team has been together through all of it. Our CXO team averages over 10 years of tenure at Satin. That institutional knowledge, that shared instinct for risk and opportunity is not something you can build quickly. It is built slowly over decades, and it shows up in the diversified businesses which we do and the resilience of our numbers. Now let me turn to the numbers, and I will keep this short since the detailed presentation is already uploaded. At a consolidated level, our AUM crossed 15,174 crore, growing 19% year-on-year. Total revenue came at 3,161 crore, up 23% YOY. Our PPOP grew 23% to 928 crore, and consolidated PAT for FY26 was 330 crore, a 79% growth year-on-year. In Q4 alone, the momentum was even sharper. Consolidated PAT grew 640% year-on-year and 125% quarter-on-quarter. This is not just a recovery. This is one of our best quarterly performances in recent memory. On a standalone basis, our AUM stood at 12,853 crore, up 14% year-on-year, backed by disbursements of 11,202 crore. Standalone PAT grew 39% for the full year and 234% year-on-year in Q4. PPOP was 856 crores, up 16%. Our key ratios tell a similar positive story. Consolidated NIM stands at 13.2%. ROA improved to 2.6% and ROE to 12.3%. The cost-to-income ratio came down gradually, and our loan loss ratio improved meaningfully year-on-year. We achieved exceptional ROA and ROE in Q4, standing at 4.71% and 23.31% respectively, which is higher than the industry average. Further, the value creation from our wholly owned subsidiaries, SGAL and STL, is expected to act as a key catalyst for further improvement in ROA and ROE in the coming years. On funding, we raised 10,826 crore during FY26. Our marginal cost of borrowing declined 43 basis points to 10.82%. We maintain a healthy balance sheet liquidity of 2,092 crores and undrawn sanctions of 2,235 crore. The ALM is positive across all buckets. We are also well capitalized with a standalone CRAR of 25.4% and 75 active lenders, underscoring our strong institutional relationship. Asset quality is rightly the area of greatest interest in this environment. It is also where I believe we have the strongest story to tell, since microfinance is not merely a disbursement business, but the business of collection. Our standalone GNPA stands at 3.1% as of March 26. Our ex-bucket collection efficiency is 99.9%. Stage 3 coverage has improved to 73% from 67% in December 25. We carry sufficient on-book provisions of 273 crore, which is 2.9% of the on-book portfolio, well above the RBI required 172 crore. We also maintained a management overlay of 20.5 crore as an additional buffer. Our credit cost for FY26 stood at 3.8%, a 77 basis point improvement from the 4.6% we recorded in FY25. In Q4, credit cost came down further to 2.5%, and our FY26 average credit cost to 3.8% compares very favorably to the numbers seen industry-wide during the stress period. I want to draw attention to a particular strength in our portfolio, the geographic spread of our asset quality. All our top states have ex-bucket collection efficiency of 99.9% or 100%. Uttar Pradesh, our largest state at 23% of the portfolio, has a PAR 90 of 3%. Assam, as I mentioned, is at 0.7%. Punjab is at 1.5%. These are not just acceptable numbers, they are among the best in the sector. What underpins this performance is the combination of tighter underwriting. Our sourcing to disbursement ratio of 39% reflects genuine selectivity. Our borrower leverage policy, no client has more than 3 MFI lender or exposure over 2 lakh disbursement. And our NatCat insurance program, which has now covered 5,800 crore in disbursements since September 25, de-risking our portfolio against natural catastrophe defaults. On diversification, our juggernaut gains momentum. Our diversification story is, I believe, one of the most underappreciated aspects of our equity story. We set out several years ago to build not just a microfinance company, but a diversified rural financial services platform. Today, 17% of our consolidated AUM comes from non-MFI businesses. Our target is 30% by 2030. The promising performance of our subsidiaries has given us the confidence to raise the target of consolidated AUM by 2030 to 32,000 crore from the earlier target of 25,000 crore. Let me give you a brief update on each subsidiary. Satin Housing Finance Limited, our housing finance subsidiary, now has an AUM of 1,267 crore, having grown at a 3-year CAGR of 36%. GNPA stands at a healthy 3% and CRAR at 53.8%. ICRA has assigned A- stable rating. Our thesis here remains consistent. The natural next step for a borrower who has repaid unsecured MFI group loans with discipline is a home. Satin Finserv Limited, our MSME-focused subsidiary, has emerged as a standout performer this year with the AUM of 1,054 crore, a 92.5% year-on-year growth. The 3-year CAGR stands at 66%. SFL operates across 14 states through 121 branches and is building a meaningful presence in green finance, having disbursed 255 crore across 34 green loans. This business represents a natural graduation pathway from microfinance for entrepreneurial customers. Satin Technologies Limited, this is a newer business but one with significant long-term potential. STL builds enterprise technology across HRMS, loan management systems, core banking, and cyber security with agentic AI as a horizontal capability across the product suite. Within 2 months of incorporation, STL had acquired its first 2 clients. In January 2026, we acquired a strategic stake in Katrino, an IIT Patna incubated deep tech cybersecurity firm focused on post-quantum cryptography. With representative offices in Toronto and Dubai, STL is already establishing an international footprint. We are early here, but we are building something that can compound significantly over time. Satin Growth Alternatives Limited, SGAL receives its SEBI license for a 200 crore Category 2 AIF, a first of its kind gender lens impact fund focused on rural MSMEs. The fund is led by an all-women team, combined financial discipline, impact orientation, and deep field presence. SGAL has signed a strategic MOU with the State Bank of India for co-investment, which is a powerful validation of the model. We are progressing towards the first close with strong soft commitments. Together, our subsidiaries add a fee income and asset management dimension to our business model that goes well beyond the traditional NBFC MFI construct. This is the architecture of a truly future-ready financial services platform. Underlying all of our business progress is a significant investment in technology and data capabilities. We use AI tools across underwriting, portfolio monitoring, and risk assessment. Our data-driven approach to credit decisions has been a key contributor to our superior asset quality. We have now established presence in over 64% of India's PIN codes, and technology is what allows us to operate with efficiency and consistency at that scale. On ESG, we received a debut score of 59 in S&P Global's Corporate Sustainability Assessment. Assessed across a comprehensive range of environmental, social, and governance parameters and benchmark against global peers, this score reflects our ability to translate policy frameworks into consistent execution. It is not a number we celebrate passively, it is a baseline we intend to build on. Our social impact is embedded in our portfolio. 100% women clients serving below poverty line households with on-lending to the lowest strata of the Indian economy. Moody's has rated our social impact at SQ/S2 amongst the highest globally. FY27, the outlook is focused and confident. For FY26-27, our standalone guidance is AUM growth of 15 to 20% year-on-year, implying an AUM of approximately 14,800 to 15,100 crore. Credit cost target of 3 to 3.5%, a meaningful improvement from 3.8% in FY26. What underpins this guidance is not optimal, it is execution capital. We have 392 new branches added in FY26, a seasoned field team present in over 1 lakh villages and 550 plus districts, a robust ALM, and a track record of 19 consecutive profitable quarters. We are not growing blindly, we are growing into our infrastructure with the discipline that has defined Satin. As mentioned earlier, we are also revising our long-term AUM target upward from 25,000 crore to 32,000 crore by 2030, with a non-MFI AUM target of 30% by that date. This reflects both the strength of our core franchise and the emerging potential of our diversified business. Before I open the floor, let me acknowledge our people. At Satin, we serve 34 lakh customers across 2,015 branches in 577 districts. None of that is possible without 18,265 employees who show up every day in the field in every weather with every kind of customer. They are the reason why these numbers exist. We were recognized this year as one of the India's top 50 best workplaces in BFSI 2026. We received the Elaben Award for Best Women-Friendly Organization, the BW Social Impact Award, the Watson Financing Award, and the Silver Scotch Award. These recognitions matter because they reflect values and not just performance. Our vision of being a differentiated rural financial services company is not a tagline. It is a purpose that has guided every decision we have made over 35 years. And it is this commitment that will guide every decision we make over the next 35. Thank you, and I will now hand back to the moderator to open the Q&A session.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Anand Tulsiram from Best Pals Research. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
Yes.
Yes.
Yeah. Sir, the first question is on your subsidiary, Satin Creditcare. So what I'm trying to understand is the customer profile, what sort of collateral you get, and the underwriting, whether it is manual, technology-based or template-based. So if you can help me understand these three things.
So Satin Creditcare does graduated microfinance customers also who need a higher ticket size. That one vertical. The other vertical is that they do green finance and emerging micro enterprise businesses. The underwriting is cash flow based, is also based on certain scores which they have validated internally for themselves. So it is not just pure manual, as what you said, So it follows a lot of data analytics based on that, various mechanisms of underwriting through looking at how we are able to generate cash flows, look at the businesses there. It is secured by receivables, it is secured by equipment, it is secured by any kind of appropriate immovable property as such. So this is not unsecured lending which we do, this is secured lending which we do across with it. I hope I've answered all the three questions that you had.
Yeah. See, what percentage of loan is against the property? Collateral is property?
So LTV normally resides between 40% to 45%, and that is what the LTV they work upon.
No, not LTV. What percentage of total book is against property? Out of 1,000 crores, what percentage is against the property security?
So that way we will not have it. It is secured. There would be some immovable property. There would be something which is on receivable, something which will be on hypothecation to equipment. I will not be able to give you a percentage, but everything is secured. I think that.
Okay. What is the overlap with the MFI customers for this Satin Creditcare?
Zero overlap. There is absolutely no overlap on this. What we have as a policy is that if there is a customer who has a microfinance loan, he will have to forego his microfinance loan and take a loan from any one of our group subsidiaries. So one loan per customer in any one of the three subsidiaries, they can probably take it. So that is how it is.
Got it. And is it fair to say that the customer's household income has to be more than 3 lakh? It cannot be less than 3 lakh?
It can be more in both these subsidiaries basically, but we follow that norm in microfinance because that is what the terms and conditions which have been specified in the guardrails.
Okay. Sir, and the last question is the customer profile in the housing subsidiary. Is it self-employed, salaried, and what is the typical income profile, if you can help me that as the last one?
It's a mix of both. It's self-employed professionals as well as salaried class also.
Let me ask you differently. Over the next 3 to 5 years, our focus will be more on the self-employed customers or more on the salaried customers?
I think it will be more on the self-employed customers going forward across.
Thank you, sir. That's it from my side. I'll join back the queue.
Thank you.
Thank you. Next question is from the line of Somal Shah from Paras Investments. Please go ahead.
Hi team, good morning and congrats on a very good set of numbers. So my question is on our X bucket collection efficiency for Q4 was at around 99.9%. So what is that number for the month of April?
It is holding on.
It is holding on. I think, I will not be able to give you specific, but it is
Holding on, similar level.
practically the similar state.
Okay. Okay. And so we are not seeing any stress currently due to the ongoing geopolitical issues. Just wanted your views on this thing.
No, not right now. There's no stress because of the geopolitical crisis across in any of our states or any of the places where we work upon.
Okay. And what was the overall collection efficiency for last quarter?
97. It was little over 97%.
Okay. Okay. And on a standalone basis, we are guiding for an AUM growth of 15 to 20% and credit cost of 3 to 3.5%. So can we know what this number could be on a consolidated basis?
On a consolidated basis or on a standalone basis?
On a consolidated. The standalone is only the GLG model, right? So just on a console basis, what this growth can be?
So the growth would probably, we are looking at 15 to 20% across over there. But as per the previous SFL grew by about 90% year on year, and housing grew by about 38%. Now keeping a mix of both that, if we add up to what 15%, that's the baseline which we are taking the bare minimum for microfinance. I think it will be closer to about 25-30%. For a consolidated basis.
Okay. Okay. And so is there any one-off in our Q4 numbers because our PAT has moved up significantly?
There's no one-off.
It's on account of reduced credit cost and growth that came.
Okay. There is no one-off, no, in the foreign exchange or something?
No, there's no one. No, there's no one-off.
Okay. And how shall we look at FY27 numbers in terms of ROA and ROE? Because I think you guided for credit costs, so it would be better if you can guide for ROA also.
See, I will not be able to give you a clear guidance on ROA. I think you can calculate it with the AUM growth as well as the credit cost. I think it's a function of that. But our senses will be better off in terms of our ROA even as per our current year as such.
Okay. So for the current year, I think we did around 2.6 ROA for full year.
Yeah.
Okay. So at least for FY27 base case scenario, can we see upwards of 3% ROA? Is that doable?
Yeah. I said, it's a function. We don't want to give a guidance, to be very honest, but, I think, we'll be positive from where we are right now. That's for sure.
Okay. Okay. And if may I ask the last question? Yeah. So what is the... So when I'm checking our presentation, our consolidated net worth is 2,868 crores, and our standalone net worth is more than the consolidated. So why is that? I mean, standalone is showing 3,129 crores.
So long ago, post demonetization, etc., we did some revaluation because of which in the the amount that we have invested in the subsidiaries were revalued. And then there was gain, and then that is why the standalone net worth is more than the consolidated.
Sorry, I didn't get you.
So, the investment that we have made from the parent company in the subsidiary, Satin Housing and Satin Finserv, that was revalued. This was some 5-6 years ago, and that profit was booked, and that is why the standalone net worth has gone up. But on a consolidated basis, that revaluation impact is removed, and the net number is 2,868.
Okay.
Hope that clarifies.
Okay, understood. That's it from my side. Thank you and all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good morning, sir. Thank you so much for taking my question. Hopefully, I'm audible.
Yeah, you are. Good morning.
Yeah. Hi. Firstly, congratulations on a great set of results, sir. So just wanted to know, effectively, we are planning to, double our AUM in 4 years, right, sir? So the growth can be faster than the 15-20%, right? Because that's how, if you have to plan to double, or is it more towards the high end, sir? How it's not going to be linear?
I think your voice is not very clear.
I think what are you trying
Just
to
1 second. Just 1 second. Sorry.
more than
Hello. Yeah, yeah. Is it better, sir?
Yeah, this is better.
Yeah, so just wanted to understand that, like we've guided to nearly doubling our AUM, right? So as if in FY27, we are saying around 15 to 20% growth, but to double, we might need to move a bit faster. So is it going to be a linear growth, or is it going to be towards the, fag end? How do you look at it, sir, in terms of AUM, long-term AUM growth?
So let me clarify. This 15 to 20% AUM guidance is only for standalone microfinance. And when we do a consolidated, we said, it'll be probably an average of about 25 to 30% is what we will grow on a consolidated basis. And that's the reason for us, the guidance which we given for 2030, we revised it from 25,000 crore to 32,000 crore, looking at this scenario across in the next 4 years.
Oh, okay. Fair enough, sir. And sir, as we are moving to more non-MFI, right? So will that impact our yield? So should our NIMs, slightly moderate, and our ROA should also be near the same level? How do you look at that, sir, in terms of profitability?
See, I'll tell you, there are two aspects to it. So when we say that the NIM are stable, I think, both our subsidiary companies, housing as well as works in the rural atmosphere, the rural financial services space. Over there also, we are better in terms of our lending rates as compared to the normal, housing finance companies and MSME lending companies. So we have a higher yield over there. That translates into, when we do a consolidated, NIM, it consolidates into about 13%, average, 12 to 30% is what it is. So it will remain stable as that. On the ROA front, the profitability which will arise from there, we've got two kickers also across over there, which will probably an enhancement in terms of our ROA, and that these two kickers are Satin Technologies, which is not a capital intensive as well as a leveraged business in terms of financial services, and similarly Satin Growth Alternatives, which will also disburse, which doesn't again have intensive capitalization structure. So both these revenue items or revenue in these subsidies will probably be a foray to enhance our ROA in the long term basis.
Oh, okay, fair enough, sir. And so just wanted to understand in terms of like our cost of funds, what are the measures that, we're doing to reduce that? Like, I think it's a bit on the higher side. And do we see any kind of, competition in terms of, our cost of funds, like, increasing? Like, how do you see that, sir?
See, I think it's again a function of, how the whole sector is evolving out to be. Based on that, we've still been able to reduce our cost of funds by about 50 basis points. Now that is pretty significant if you look at the current scenario emerging out of in the microfinance business. Our own sense is that the way we've been able to operate, I think we will probably be stable, or for us, there is no enhancement which will happen in our cost of fund. In fact, it will probably be fair to say that, it will further go down whenever the need arises, whenever the repo rate goes down. I think, looking at that, and I think this is a function of all these factors put together.
Okay, fair enough. And just last question from my end, sir. So right now, due to the geopolitical conditions, like, is there a chance of, maybe inflation creeping up and then like RBI has to come in and set up some measures? Because right now, even our Prime Minister just had a speech in terms more of austerity measures. So is there like a problem like where we see that, credit growth can be impacted for a few quarters, not on a long-term basis, but like a near-term, jerk can come or a speed bump can come, right? So what is your thought process on that, sir?
See, our thought process is kind of a slightly different, from there, So, yes, fuel prices increase and all this could lead to maybe some kind of an inflation uptick. But when an inflation uptick happens across over there, the justification always has seen whenever there is a slight uptick in the entire economy as such, the credit disbursements grow up. Income levels will definitely probably be shortened by in terms of inflation spikes. So what happens is normally the borrowings adds up at that point of time, So for us, demand will pick up. which I feel probably will be the reason why we've been able to say that we'll be able to grow by 15 to 20%. So income levels will definitely go down a little bit, but in the end, ultimately the demand picks up. So that's what the analogy which works upon on this.
Okay, fair enough, fair enough. That's it from my side. So thank you so much.
Yeah. Thank you.
Thank you. Participants, you may press star and one to ask a question. Next question is from the line of Raghav Batoria from Lindsay Securities. Please go ahead. Hello, sir. Am I audible?
Yes, you are.
Yeah. So my first question is that, in our results, there is a line item, net gain on derecognition of financial instruments, something around 144 crores. So what is this exactly?
144 crores. You're talking about the consolidated numbers.
Yes.
Standalone is 129. That's the deal.
So you're talking about so this is the gain on the forex that the borrowing that we have done in the foreign currency, and the corresponding expense item is the effect of change in the foreign exchange rates.
So there is a 92 crore effect of foreign exchange rate, and then there are two line items, net gain on fair value and net gain on derecognition. So
derecognition is a DA income. Derecognition is a DA income. The net gain on fair valuation is the treasury income on mutual fund and the forex contracts that we have taken.
So this treasury income in environment where yields have gone up so much, is this something that can continue? Because I think this is sort of helping your profitability for this quarter.
No. So treasury income is what we actually do when we have got sufficient liquidity or more liquidity be there in the system. It is not relatable in terms of the business expense. So normally we carry a 2-month liquidity with us, and that is always invested in mutual funds for a shorter period of time. So that is there, and it has probably no relation technically to your business as such.
The better way to see is the NIMs. So NIMs are broadly stable at 13.5 to 14%. These gains, because of timing difference in the exchange rate fluctuation, etc., impact the top line and the corresponding finance costs in different periods. But will get neutralized. But if you see the NIM over a long period of time, we are sort of say broadly stabilized between 13.5 to 14%.
Okay. My other question is on your cost of borrowing. So we've seen a sharp increase quarter on quarter and year on year. Is this just because of the forex impact, or has it actually gone up?
So that also impacts the quarter on quarter numbers. So it is better to see the annual numbers and over a period of time. This gets neutralized because all the foreign borrowing is fully hedged. So there is no long term impact on the bottom line because there is no forex risk. But quarter on quarter number, depending upon the dollar movement, etc., this marginally impacts the profitability. Both sides, positive and negative.
Okay, thank you.
Like last year, there was a overall 25 crore of negative impact on the bottom line in the whole year.
Okay.
Thank you. Participants, you have press star and one to ask the question. Next question is from the line of Subhanshu Mangal from Three Head Capital. Please go ahead.
Yeah, thank you for the opportunity. Hope I'm audible.
Yes, you are.
Yeah. Sir, can you tell me what was the Q4 credit cost, console level?
Q4 credit cost?
Consolidated.
Console level Q4 credit cost.
You want the absolute number?
Yeah.
You want the
percentage? No. Give me the percentage.
You want the percentage?
For the
yeah.
this was 3.5.
See, for Q4 you're saying, no?
Yeah.
You're saying for the quarter or Q4?
I want both, but first I want to understand the Q4 credit cost.
Voice is breaking up, it's not audible very.
See, credit cost at consolidated level for quarter 4 was 2.2% in terms of percentages, and in terms of absolute amount, it was 79 crores.
And is this console basis, right?
Yeah, this is consolidated.
Yeah, consolidated.
Okay. And what was the FY26 credit cost consolidated basis?
3.55%.
Yeah, 3.55% was the FY26 consol credit cost. That's correct.
Okay. And sir, as you mentioned, our non-MFI mix will be increased FY27 and up to FY30. Then overall yield will be reduced. That's my understanding, correct?
No, we didn't say that.
He's assuming that the yield.
No. So there's no assumption, which we've given across over here. For us, we said we've got a very stable NIM across, and this will probably hold true for us in the future. So there's no, I think, there's no area where we've said that there will be a drop in the yields or the NIMs.
Okay, but normally housing finance and MSME business has lower yield than MFI. That's why I was saying this. What was the MFI and housing finance yield in our subsidiary?
We work majorly in the rural platform. We work majorly in the rural space. Over there, the yields are much better than the normal traditional housing finance which you look at. Over here, for us in housing finance, our average yield is close to about 15.5% to 16%, and this will remain stable across because the constituency which we serve in is very different from the normal constituency which our housing finance company serves across.
And then just to add, in spite of both housing and MSME business going up, our NIM was 12.42% for FY25, which has gone up to 13.23% in FY26. So in spite of their share going up, the NIM has also improved.
Okay. Thank you. And that's all from my side. Thank you. Best of luck.
Thank you.
Thank you. Participants, you may press star and one to ask a question. Next follow-up question is from the line of Anil Tulsiram from West Pals Research. Please go ahead.
Yeah, thanks a lot for the opportunity again. This question is on the standalone MFI business. So many of your peers are shifting to the high-ticket individual loans. So what's our strategy there?
So we are doing pilots on that, but for us, JLG will remain our mainstay. That's very clear. We are doing pilots. We've done very small disbursement in terms of our individual loan. We're getting very good results in that, but we will not shift to just one as such. There will be a hybrid of JLG, but predominant is going to be JLG.
JLG will be only for the new to company customers or even for the credit customers who have done 2, 3, 4 cycles in the MFI already?
No, it's for everyone, basically. It's not, we don't distinguish between a new to credit customer as well as an existing customer in JLG,
Got it. And sir, from the disclosures, it looks like the incremental yield on microfinance is around 25-26%. Is my understanding right?
Broadly, yes.
Broadly, yes. Average is
around 25%.
So now the question is from the RBI side. In the past, RBI has, I don't know whether my understanding is right or not, something like 20-23%, and then they started making a lot of comments about the interest. So this time, you think it is again a problem going forward after 1-2 years, or these are sustainable yields?
See, you'll have to understand the context on this. It's very easier to say this, that it is being done by the regulator. The regulator is appreciative of the effort that we are doing financial inclusion to a large extent. It's a doorstep delivery. Plus, our credit cost as well as other stuff has been elevated in the last few years. Looking at that, the cost of fund as well as the operating cost for delivering such a small ticket size loan and a risk-based pricing was fixed, which I think, everybody is aware of. So there is no question where I think it could be singled out as in terms of that, and it's a interest rate, it's an interest rate play, which is going to be there. You have to look at the complete ecosystem onto that.
Got it. Sir, and can you help me understand this green finance loans? It's not very clear to me, which you do in your subsidiary. What exactly is the nature, customer profile?
Sorry?
Green finance.
The green finance loan which you have spoken about.
Yeah, so these are micro enterprises to a large extent, basically, and it could be green renewables energy, it could be green finance, it could be solar, it could be EVs, it could be enterprise EVs. It's a combination of all that.
Got it. And sir, the interest yield in the Satin Finserv, is it closer to the MFI customers only, or is it far lower, like housing?
It's closer to the MFI, yields as such.
Got it. And sir, the last question is on the industry. The guardrails have been implemented because of the current issues. So do you think these are currently here to stay, or going forward, individual players will be left on their own, whether they want to follow or not follow?
See, ours is zero. We don't have a customer which is flouting any kind of a guardrail. And I think, looking at the industry, it is here to stay.
Got it. Thank you, sir. Thank you so much for all the detailed answers. That's it from my side.
Thank you. Ladies and gentlemen, we'll take that as the last question. I'll now hand the conference over to the management for closing comments.
Sure. Thank you, everyone. This year was a great year where proof met promise for us. Our Concall AUM grew 19%. We crossed 15,000 crore. Our disbursement grew. Our Q4 alone disbursement were 43% up. The credit cost came down 80 bips for the whole year. The, I will say, X-bucket collection efficiency is holding on. And these aren't just metrics. They are the outcome of decisions we made long before the results arrived. It's for the years we are doing the consistent performance. Subsidiaries are no longer a passing reference in our overall scheme of things, if you see. They are forces in their own right. Both Satin Finserv and Satin Housing have crossed 1,000 crore AUM each. They are a move for the future. Satin Technologies has its own USP, and then it again made a bold bet on deep tech cybersecurity, which is signaling that our intent to build infrastructure-grade capabilities is for financial services is beyond parallel. Satin Growth Alternatives, the women-led AI fund, with a sharp focus on women entrepreneurs and sustainability, is not just a new business line. It's a statement of purpose. It is deepening the impact that we do on ground. What FY26 ultimately tells us is simple: discipline at the ground level, clarity at the strategy level, and patience at the management and board level. This combination wins every single time. To our investors, lenders, and the millions of borrowers who place their confidence in us, this year's performance belongs to each one of you, and thank you for all your support. If you have any queries after this call, you can reach out to Valorum Advisors, our IR advisory, or you can reach out to me. My name is Aditi Singh. I'm Chief Strategy Officer at Satin Creditcare. Thank you, everyone. Have a great day.
Thank you very much. On behalf of Daulat Capital Market Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.